Hi viewers, welcome back to sharing session learn of corporate finance course of Prof.Roy Sembel at IPMI International Business School. In this week, I would like to share you our final course summary. Totally, in 7 weeks, we already passed the course. Let's go to the first summary. We learned about introduction of financial management. Financial management is optimal orchestration of internal and external financial resources towards significant and sustainable value creation. The main goal of financial management is the basic objectives. To obtain profit maximization and wealth maximization in order to approach significant and sustainable value creation. One item to manage by financial management, there are 8 items: capital structure, working capital management, asset structure, reduction of fixed asset ratio, revenue management, cost management, cash flow management, growth management, risk management, lower risk appetite. The most subject to talk about financial management are cash flow between the firm and the financial market. Financial market input debt or equity shares invest to the firm to be utilized to financing the firm business process. Hence, firm will give output to financial market to pay the debt or dividend. Some will pay to the government as taxes, and some remain to the firm as retained earnings. However, the story and the people behind the numbers are equally, if not more important. Principal agent problem, corporate governance, stakeholder conflict of interest, and ethical behavior. Whereas corporate governance tariff stands for transparency, accountability, responsibility, independency, and fairness. Goal of the firm is to maximize profit, not specific enough to timing and risk. High profit will high risk, and as quick as we get, we will not be present in the next another time. Sorry. Second is maximize shareholder wealth by maximize stock price with excellent performance and good corporate governance and efficient market follow the market trends. There are sometimes agency problems between shareholder and management. And then four cornerstone of corporate finance, there are core value principle, combination of growth, return on invested capital, or ROIC, and healthy cash flow, drive value creation. And at the end, the growth and ROIC should generate healthy cash flow. Second, conservation of value principle. Value is created when companies generate growth, ROIC higher than value ACC, and eventually higher cash flow. The expectation treadmill principle need to carefully manage both external expectation and internal fundamental to maintain stability balance. Or the best owner principle, a business value depend on the who owns and or manager it or might own. Value for money translate like $1 today into the equivalent in the future, called compounding, or translate $1 in the future into its equivalent to called discounting. Second, we learn about capital budgeting, about how company decide project by the investment calculation of return or planning process for investment in long-term asset. There are some decision criteria. First, payback period. Second, net present value, and then profitability index and internal rate of return or IRR. We learn about analysis of securities. It is learned about how the big picture of investment strategy, and lately we also learn about the personal financial plan, about the sales principle. Back to the big picture investment strategy, come up with fundamental analysis, technical analysis, and market or investor sentiment. In fundamental analysis, it is very important to understanding the company financial statement, and then we can evaluate its ratio. There are core analysis that we can use to decide the company operation and financial statement in healthy or unhealthy by examine the profitability, ROA, and liquidity, CR or QR, then activity, CAT, DFAT, leverage, DFR or DR, market ratio, dividend yield, PER, and MTP. And then we examine healthy or unhealthy. First, about natural level is, for example, current ratio above 1 and quality of number. We examine about current ratio and the quick ratio, about the historical trend, getting better or worse, and benchmark into the industry, above or below average, and decomposition by DuPont analysis. We also learn about how Warren Buffett way to invest. Turn off the stock market. The stock market is manic depressive. Second, don't worry about the economy. Buy business that has the opportunity to profit regardless of the economy. Buy business, not a stock. Apply Buffett tenets to screen the business. Manage a portfolio of business. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. For the technical analysis by analyze the trend of stock move. There are momentum versus reversal, trend, uptrend, downtrend, support, resistance. Gap, common, breakaway, measuring exhausting gap, triangle, double bottom, head and shoulder, inverted H&S, moving average, filter rule, etc. Examine the capital asset pricing model. We compare with the market return and the risk with CAPM. Structural lending consists of financial structure, current liabilities plus long-term debt plus equity. And then capital structure come from long debt plus equity. Modigliani and Miller. No transaction costs, no tax, everyone has some information and borrowing rates. Debt is riskless. Debt does not affect operation, there are flat line. However, wrote the important paper in 1958 in which they proved that with tax deductibility of interest payment, the optimal capital structure is 100% debt. However, capital structure in the real world, firms attempt to balance the cost and benefit of debt to reach the optimal mix that maximizes their value of the firm. Because effect of the cost of capital, since debt is cheaper than equity, use of debt will initially lower the WACC. At high level of debt, the WACC will increase as investors perceive the firm to be riskier. SWF is a state-owned investment fund comprised of money generated by the government, often derived from the country's surplus reserve. It become a problem if the GCG are not there, but it will be a solution to leverage the capital structure of the country. If the capital structure has problem, it will come up with financial distress. Can be observed the performance stage due to the cash flow financial distress cycle. What is the outcome if the company have the financial distress problem? It can be survival mode or permanent problem. With survival, company can do operation restructuring, asset restructuring, and financial restructuring. If the problem permanent, then company will be liquidated and file for the legal bankruptcy. How to survive anyway? Stop the bleeding, financial restructuring, temporary pivoting, strategic realigning, redefining core business, new ways to doing business. One of the corporate structuring that we've learned in the case is LBO, leverage buyout, whereas the LBO, the asset of the company to be acquired, is used to the collateral to borrow money to acquire the company by another company who is healthy financial. Fraud risk management. The reason happened by the fraud triangle. There are perceived opportunity, rationalization, and perceived pressure. As manager, actually, we can learn from the early warning signal. To prevent, we can build ethic, SOP, whistleblower, incentives. We can use a physical incentive, monetary, social, and moral. Dividend policy. As a shareholder, stock return consists of capital gain from stock price plus dividend yield. As a company, there are the dilemma to paying the dividend or use the retained earning to financing the company operation. In order, dividend matters because of it indicates the company follow their obligation in order to increase their value creation of management. A good company always pay the dividend and sometimes moreover increase the dividend yield. Investor form expectation concerning the amount of firm upcoming dividend. Expectations are based on the past dividend, expected earnings, investment, and financing decision, the economy, etc. The stock price will likely react if the actual dividend is different from the expected dividend. Okay, then we go to international finance. There are foreign exchange market, allow currency to be exchanged in order to facilitate international trade or financial transaction. Foreign exchange transaction market or immediate exchange is known as the spot market. If trading between banks occur in the interbank market within the market, brokers sometimes act the intermediaries. Forward market enables the multinational company to lock the exchange rate at which it will buy or sell in certain quantity or currency on the specific future date. Foreign exchange are concerned with the quote competitiveness, special banking relationship, speed of execution, advice about current market condition, and forecasting advance. Currency future and the option market can do by currency call or put option, give the right to buy, sell, or specific currency at a specific price, while the strike of exercise price within a specific period of time. Okay, that's all for the summary of this course. Thank you very much to join and hope you enjoy. Thank you. Bye.